Hello, this is Kahlil Adam, Head Investor at Itaú Private Bank, and I would like to thank you for joining us once again for our monthly international markets update for November 2023. What a turnaround! Since entering correction territory late last month, meaning the S&P was down 10% from its recent highs, the index has seen a massive reversal. The S&P is up 11% from its recent lows on October 27th and is within 2% of its 2023 highs. Accompanying the strong rally in stocks has also been a big rally in U.S. bonds, which are up also 11% since October 27th. It's tough to pinpoint one single explanation for the risk-on move in U.S. markets, but one of the main catalysts has been the improvement in the outlook for inflation without a significant deterioration in economic data. Let me be clear, there are still many signs of weakness in the U.S. economy. From manufacturing to housing to consumer sentiment, and most importantly, bank lending standards that remain tight, coupled with the lagged effects of the Fed tightening cycle, the debate about a hard versus soft landing remains very much alive. But this month, undoubtedly, we received further confirmation that inflation is clearly pointing to a point where the Fed is more comfortable remaining on hold and indicating that this cycle may be over, at least for now. Headline CPI came in flat month over month and up 3.2% year over year, while core CPI, ex food and energy, came in at 4%. Obviously, this is not the 2% target that the Fed has, but it's still very much in the right direction. This data is already quite encouraging, but more impressive is that it comes while the economy remains buoyant, supported by strong consumption as unemployment remains close to cycle lows. Again, we are not out of the woods when it comes to inflation, which historically has come in several waves in past spikes, and therefore we remain vigilant. And of course, 1 month does not a pattern make. But if I were to take away one clear message from this November rally, it's that markets are very encouraged by inflation coming down and giving the Fed room to pause. And yet, it has not come at the cost of higher unemployment. Not yet, at least. In fact, the Atlanta Fed tracker, which forecasts GDP numbers, is pointing to roughly 2% up for this quarter. So for now, I'd say all eyes are on unemployment figures, and I'd watch continuing claims in particular. If the labor market remains strong through year-end and into Q1 2024, I'd say there is room for further optimism in the soft landing camp. Thank you once again for joining us this month, and please reach out to your banker or investor if you have any questions. See you next year.